got it so wrong. We went from 7 to 3 to now 2 and some perhaps none at all. I mean, your thoughts on the data that we've seen so far and the repricing we're seeing in the markets?
Well, I think when it comes to the US, it's very clear that the Fed is going to take a very patient and cautious approach when it comes to potential easing of policy. We have dialed back our expectations for when we do see the first cut. We're expecting that it will come in September and then possibly one more in December. I think that the data just doesn't support a more aggressive pullback in this restrictive policy at this point. We've got still elevated CPI, but also importantly as well, the labour market is holding incredibly tight, and that's also feeding through to the underlying strength in domestic demand and also underlying inflation as well. And I think the Fed is very cognizant of these data points, and so they're not, wanting to move more aggressively than potentially only seeing 50 basis points worth of cuts this year.
Katrina, you've gone from 3 to 2. What are the chances you may go to 1 or 0?
I mean, at this point, you can't rule anything out, right? And what we're seeing from central bank officials, including the Fed, is that they're really being guided by the data. There's no clear set path here. They are looking at what's happening, and odds that we might see even more pullback in how many rate cuts we do see this year is high, unfortunately.
And Paul, of course, we saw a major repricing in Treasuries. In fact, 2-year yields just under 5%. I mean, is it justified?
Yeah, well, it's definitely been a pretty painful week for investors in fixed income. Right up until the start of this week, we've seen plenty of buying interest around those 4.5% levels in the 10-year Treasury. But we've blown through that and kind of eviscerated some of that as well, with the market really pricing out pretty much a whole cut just in the space of 1 week. But it does feel like maybe the market was a little bit slow to really wake up to what was going on. The Fed policymakers have been telling us it pretty noisily already, and it's just a question of really seeing that data with it all crystallizing around the CPI number that really triggered that move. That said, it didn't create the kind of turbulence you might expect across the rest of markets, despite that big move backwards in the Treasuries market. Repercussions for us, kind of interesting. Our dollar, your problem, the fight back from the PBOC in particular, drawing that line in the sand, and then the Bank of Japan having to grapple with the weakening yen as well. So, I think the repercussions for us are almost as interesting and important as they are for the Treasuries market as well.
Exactly. You got to wonder what central banks in this part of the world will be doing. We had Indonesia all set to cut rates, and now it's holding back because of pressure on the currency. How is this factoring, shaping the thinking in this part of the world?
Yeah, well, I think that's it. All of the central banks are going to have to take into account what's going on with the dollar and what that means for their markets, and also what's going on with inflation. On the one hand, you do have some recovery in industrial production and manufacturing output, exports. You do have commodity prices showing some recovery signs as well. And you've also got that kind of Middle Eastern factor, which has been buoying oil prices recently. On the other hand, central banks would like to be able to stop hiking and start cutting again. And so wrestling with that kind of dilemma, being stuck with over high interest rates in order to prevent too much currency weakness and an inflationary environment is making it very awkward for a lot of them.
Katrina, let's bring you into this conversation. I mean, we talked about how USD exceptionalism is putting a lot of pressure on Asian currencies, and central banks here are now back to worrying about what the Fed may do and where inflation is going to end up.
Oh, definitely. And I think they were always closely watching the Fed. And I think it was hoped that, the Fed would start to cut around June, and that would provide relief for or the opening the door really for central banks over in Asia Pacific to start easing. But what we've seen is that, obviously with Fed rate cut bets being pushed out, that is bringing that currency weakness really back into play. We saw it from the won today when the Bank of Korea did signal that they were holding rates. And so I think it's an ongoing story. And I think that currency weakness is going to remain front and center because of the addition to imported inflation that it brings, because in this part of the world as well, inflation is clearly not back to central bank target ranges in most places. It is still above comfort levels, and now with that ongoing renewed currency weakness that we're seeing, that imported inflation is coming into play. Unfortunately, at the same time that we're seeing elevated energy prices are up about 10% in the past month. That's significant, and if producers do have that ongoing pricing power to pass on those higher input costs to the consumer, we might actually see that renewed risk to inflation come up again.
Which countries are most at risk? Would Indonesia, for instance, with its subsidies, be it?
I mean, it's hard to pinpoint one in particular. I mean, what we're looking at, across the range, particularly in Southeast Asia, there are significant risks there. I mean, we've seen that, other economies like Singapore, for instance, that are heavily reliant on imported fuel and food as well. They're another one that is really at risk of this higher imported inflation kind of derailing expectations for easing later in the year. Indonesia, with its fuel subsidies, as you mentioned, is certainly there. There's others as well that no economy in Asia is really immune to higher energy prices and then that risk of inflation resurging, unfortunately.
And so, Katrina, to put you on the spot or to drill down on that just a little bit more, do you think that, kind of 6 months down the line, we will have been able to ride it out in Asia, or do you think it's all going to end in tears?
I mean, the expectation and the hope is that we will be able to ride it out, but I think a lot does depend on what happens with energy prices. I mean, Russia's invasion of Ukraine early in 2022 really crystallized just how important energy prices are to shaping the global economy, and in particular to shaping monetary policy making across the globe and, of course, in Asia Pacific. So if we can see some sort of receding in energy prices, then I think that's a positive, and I think that will give central banks across the globe, including the Fed, but also here in Asia, a bit more breathing space, because we should see inflation continue to recede. But if we do see that resurgence, then I think that will be problematic, and then there could be tears under that circumstance. But that's not our baseline circumstance.
Katrina, trade data out of China today, GDP data out of China next week, deflationary pressure still the issue for China.
Oh, definitely. I mean, what we're seeing in China is that domestic demand is still incredibly weak despite policymaker efforts. They're being targeted efforts, but there's still being stimulus on the monetary front and also the stimulus front as well to try and reinvigorate domestic demand. But we're just not seeing that come through. Households are just not out there spending as exuberantly as we would have expected them to be in the absence of COVID policies no longer being there. What we're seeing as well is that private investment is still incredibly weak. But I think more critically that the property market is still correcting. Forward indicators are pointing to ongoing correction. And it's unfortunately was this huge growth driver of the economy. And unfortunately, the industrial side of the economy isn't roaring back to help pick up the weakness in the property market at this point.
I find it really interesting what you're saying there, and that creates this kind of really polarized sort of worldview where you have, the inflation that's going on in the US and the higher bond yields and pressure in that direction, and in China, the disinflationary kind of impulses and the lower bond yields, and that's creating that really huge pressure now that we're seeing on the yuan. How do you think that the PBOC is going to manage those currency risks and get through this?
Yeah, it's a really interesting question, and I think what we're seeing from the PBOC is a concerned effort, and I think we will unfortunately see ongoing weakness when it comes to FX in China. But I think what's really interesting as well is when we actually dig down into the inflation data in China. I mean, headline inflation is contracting. If we look across the first quarter, it was actually flat. But core inflation, so if we're excluding food and fuel prices, it's doing a little bit better. It's almost at 1% year on year, which is better than what the headline suggests. And what is causing a lot of that. When the headline weakness is, of course, pork prices, they do have that abundance of supply, and so that's contributing to it. But underlying inflation pressures are actually showing a little bit of signs of improvement. It's still not fantastic by any stretch of the imagination, but it has improved. So it does give us a little bit of hope that domestic demand, although it's still weak, it's soft, but it is still kind of gaining some traction, which is a positive development. But because we do have those weak inflation pressures, it does give the PBOC that flexibility to at least provide some ongoing targeted relief, and that they will, tread that very carefully because of the subsequent implications on a weaker FX.